Hello and welcome to Inenco's Energy News Update. I'm Katey Siddall and I'm joined with Nick Campbell, who's from the Energy Trade Desk. Nick, thank you for joining us this morning. Last week we reported on Ofgem's prediction of an energy gap by the middle of the decade. In a move which increases the concern, the Environmental Audit Committee has called for an increase in carbon taxes to support the development of new low-carbon generation. Europe's flagship carbon price is the European Union Emissions Trading Scheme, usually referred to as the EU ETS. This is currently bumping around the €15 per tonne level, whilst the target price is €23 to €25 per tonne. Generating companies like EDF have said that the major investments, like nuclear plants, to be viable, the carbon price needs to be more like €40 per tonne. Nick, can you just talk us through what the EU ETS is?
Sure. It's a scheme aimed at very large emitters of carbon, like power stations. The total expected emissions are calculated and each government then requests allowances from the scheme to cover these emissions. If we take a particular power station, it receives its allowances free of charge, and at the end of the year surrenders enough allowances to cover its emissions. If it has too many, it can sell the balance on a carbon market. If it has too few, then it has to buy them.
So, if the allowances are free, why does the carbon price affect energy prices?
It's a little more complicated. The generating companies have historically been the ones who have needed to buy extra allowances, and these have come from heavy primary industries like iron or steel. So a proportion of the power we use actually has a carbon price added on. There is a perception that, though, generators have passed the carbon cost through on all the electricity produced, so if carbon prices rise, then power prices rise too.
I see. So if carbon prices rise, the price of power from fossil fuel generation will rise significantly. But how does this help investment in low carbon generation?
A low carbon generation such as renewable or nuclear demands significant investment, Kate. In order to make a return on that investment, the power produced must be sold at a higher price than in the current market. If higher carbon generation is passed on at €40 per tonne, roughly carbon costs at the moment, then the market price would rise to a point where the nuclear power was seen as economic. You might argue that because of the allowances are given out for free, that this approach shouldn't work, but it seems to.
Why has the carbon price fallen?
With demand for power reduced by the impact of the recession, there's less need for generators to buy extra allowances. At the same time, with heavy industry using fewer and fewer allowances, there is even a bigger surplus to sell onto the market. Simple supply and demand pushes down the market price.
So what can be done to improve the situation?
There are two things that could be done. If generators had to buy their allowances, then fossil fuel generation will become less attractive and generators will be more likely to invest in renewable projects. The price could be set at a level to make this happen. Also, if the total number of available allowances was reduced, then they will become more valuable. This will push up the cost of exceeding targets and again incentivise investment. We need to realise that the objective is to push power prices higher up to a point where low carbon generation becomes financially viable. This is good for reducing emissions but does increase the costs faced by the end user.
Thank you, Nick. This week, a report by a group of business leaders, including Sir Richard Branson, has warned that the world faces an impending oil crisis. It predicts that without action, the next 5 years could see oil prices rise dramatically, pushing consumer prices up, but also potentially sparking a fresh recession like the one in the 1970s. Nick, this all sounds very worrying. What's behind these predictions?
Well, Kate, since the 1950s there has been this concept of peak oil. It's the point where the rate of oil that can be produced reaches its maximum. After the peak is passed, then production begins to decline. The new report asserts that this peak oil point is imminent and that in fact we've only been insulated from the effects because the global recession has slowed down demand. If you imagine that as recovery continues, then there will come a point where we're using oil as fast as it can be produced. As economic growth continues, especially in countries like India and China, then demand for oil will outstrip the production rate. Just like with carbon pricing, if demand is greater than supply, then prices will generally be pushed up.
How would oil prices affect the price of our energy supplies?
When gas was first introduced to the market, it was seen as a replacement for heating oil. In order to set a price for the gas, it was tied to the price of oil. So if the oil market was to rise, so will the price of gas. This then rolls through to the electricity because of the major use of gas is as a generation fuel.
And how do oil prices lead to a recession, as the report suggests?
If oil prices and energy prices rise strongly, then it suggests that all consumer prices should follow. But unless the rest of the economy is growing strongly, then incomes tend not to keep pace. This means that we buy less, so the economy becomes more stagnant or even falls into recession. This is what we saw in the 1970s when conflict in the Middle East created a series of oil price shocks.
So is this prediction likely to come true?
Well, okay, we've seen a number of predictions about peak oil point really being reached, and as yet this situation hasn't occurred. It's worth remembering that as oil prices rise, then alternative sources like the Canadian tar sands start to become more economically viable, so production rates can start to rise again. We can of course improve the situation by looking at ways to reduce the amount of oil we use. This brings us back to renewable energy, particularly if it can be applied to transportation. So like the higher carbon costs already discussed, it's likely higher oil price will stimulate further investment in both low carbon transport and the generation required to power it.
So would it be fair to say that all factors are pointing to higher energy prices in the future?
Based on what we know today, then yes, we should expect energy prices to rise. The question is, can we find some sort of balance where reducing demand can enable us to maintain economic growth whilst we're looking to transit into a low carbon economy?
Nick, thank you very much. That's all that we have time for this week. Thanks as always to Nick. Thank you for watching, and from Nick and myself, goodbye.